Well, thank you for joining me for part two. Remember the three things to do for clients: go to advisor, optimize your wealth, and service with integrity. With part two, we're going to talk about the same question, just the other half of the answer. So, as was alluded to before, the other half of the answer is talking about the economy and the strength of earnings. So let's take a look at the economy for the last little over a year or so. Now, we don't have Q2 numbers by the time of this recording, but all estimates point to something like a 2.1, 2.2% GDP growth in Q2 of 2026. And Q3 arguably looks even stronger. But let's go back here for just a second. Q1 was negative last year. Q2 and Q3 were extremely robust, and Q4 was more moderated, and then Q1 was about 2%. The U.S. economy grows at about 2% a year. That's been true since about the year 2000, so almost 25 years. It's actually really been true since about 1970 that we grow at about 2% a year. Q4 we grew at about 2%. In Q1, we had the tariff issue, and I know people have already forgotten about it, but when you buy things from overseas, it's a negative GDP number. We had companies buying years-long supplies because they thought the price was about to jump. So we had a lot of buying, very negative for GDP. If you had more normalized buying, we talked about this at the time, GDP would have been about 2%. Q2 and Q3, you had very little overseas buying relative to historic norms. Why? Well, because if you buy a years-long supply of something, you tend not to buy a whole lot the next week. So we probably, if you had more normalized buying, probably had numbers around 2% in Q2 and Q3. Q4, we had a government shutdown, which I think everybody's forgotten about. That probably took about a full percentage point off of GDP. We probably had a growth of right around 2%. And then in Q1, we had 2%. And in Q2, it looks like we're going to be a little over 2%. Seems like I just keep saying that number over and over again. That's kind of been the story. And this is very important because everyone told me we had to have an aftershock recession from COVID. That didn't. We're 6 years removed. This isn't happening anymore. And then when the Fed raised rates in 2022, people said, 18 months to 2 years later, we have to get a major recession. That's what happens when the yield curve inverts. We're beyond that now too. When you look back, the yield curve uninverted last year, and it doesn't seem like it's going to revert here for a while. The U.S. economy looks strong. If anything, Q3 maybe looks stronger. The economy has been incredibly resilient during this period. As for the market, well, let's take a look here. The market right now is up about 9% year to date. It fell about 9% a little bit earlier this year, partially due to the Iran conflict during that period. But last year, right, the market fell 19% from peak to trough on the tariff news. But it ended up 16% for the year. We are on our fourth possible year of positive returns. If you look back in the last, 40 some odd years, there's not very many times you have 4 positive years in a row. Right? The last time you did that was the end of the 1990s. It's very possible that happens again. But if we have a slightly negative year, it's not putting us off track. Are we fairly confident overall? Yes. But can you have hiccups? Of course. But this is also why you try not to time the market. If you timed the market for tariffs last year and you didn't get in at the right time, you missed a big recovery and you missed a pretty good follow through. So when we're looking, is the market volatility over for this year? Look, I didn't have the Iran conflict on my bingo card this year, and there's probably something else I don't have on my bingo card that could happen. But we have to remember the market typically follows earnings, and earnings, not perfectly correlated, but oftentimes correlate with the economic strength. And the economic strength is good. It's easier for companies to make money during good periods of economic growth. And that is really the story. We look at price to earnings ratio. And if you don't remember what price to earnings ratios are, how much am I willing to pay for a dollar of earnings? Historically, we pay about 17 times, meaning I'll pay $17 for a stock, and I expect it to make me $1 every year. And hopefully, because it's a stock, next year it makes me $1.03, and then $1.07, and then it continues to grow, and I get paid back in a little over a decade, and that's a fair return for my money over time. We've been paying near historic highs recently. And when we started the year, we were closer to 22 times earnings. And if you remember, the last time we paid those sorts of numbers, it was the tech bubble, and that's what everybody brought up this year, is the tech bubble. The other thing is 2022 earnings were flat. They were actually up 5% in 2022, and they were flat in 2023. But in 2022, the market fell more than 20%. That was just a repricing of price to earnings ratios. That's, if you look here, that's that dip after COVID. You see this big wild spike during COVID because we paid over for a bunch of companies that weren't making money, but were expected to in the future. In 2022, we repriced, and the market went down, even though companies made more money. 2023, this number recovered, even though earnings stayed flat, but the market went up, and it's been going up and accelerating. It's expecting perfect and ultimately fantastic earnings, and recently here it's come down. And people will ask me why. Well, going back to that market follows the correlation of earnings thing, this is why. Earnings this year have been incredible. If we zoom in here the last few years, we grew at 10, 13% the last 2 years. We're at 24% right now. It's probably going to be more like 26%. 26% earnings growth. You can see there's not that many big spikes, but all these other big spikes are coming out of huge recession. The last time you see the 49% spike, that's coming out of COVID. That's a huge recovery number. 26% is incredible growth. When we started this year, we were thinking more like, 12, 13, 14%. The highest expectations were near 14%. Even next year, we're talking about possibly growing at something like 13, 14%. We're looking at 17 right now. So although the market has hit new highs, it's actually cheaper on a relative basis because the earnings that we kept expecting and needed to see in order to validate those came through. And actually, we're seeing the S&P equal weight rise faster than the broader S&P. We're seeing a broadening out. People talk about the Mag 7, and they've been a little more muted this year. But why has the market still been relatively strong? It's because the broadening out, we talked about, that has to happen for a sustained rally over time. And that actually looks very positive, and that story is coming to fruition. We're actually watching it happen in very much real time. So, our big surprises this year, the economy has been even more robust than I think people thought possible. Earnings have been incredibly robust, and the market is actually, on a relative basis, gotten a little bit more reasonable, even with it hitting new highs. We had one of our strongest quarters here in Q2 of 2026, and we don't see a huge reason why that expectation can't continue. Doesn't mean there's not volatility ahead, doesn't mean there's not something else that can come out and arise, but for the most part, things look pretty positive. But with that, thanks everybody for joining me, and we'll see you guys next time.